this is part 1 of the chapter 2 demo. We're just going to do the first half of the demonstration. So what we're going to learn in chapter 2 is the T accounts, and then in the second half of the demo, once you've done the homework and practiced the T accounts, then we will go on and finish the rest of the steps for the demo for the second half of chapter 2. So the first thing I need all of you to do is to get out your T account helper sheet, and we're going to fill this out together. And with the T account helper sheet, we're going to start with our assets. Remember, assets are things that we own. So we're going to label the first one on the left, assets, and put a little asterisk up there, or star, at the top of assets there. And then go down to the bottom on the left side and put your asterisk. And this is going to apply to cash, supplies, equipment, accounts receivable, prepaid insurance, which we will learn, and prepaid rent. So these are all assets, things that we own. You've worked with several of these in chapter 1, but we're going to introduce a few more of those as we go through chapter 2. So let me explain prepaid insurance. Prepaid insurance works with when we purchase insurance policies, like for our car or our renter's insurance, things like that. So when you buy insurance, you're prepaying for the upcoming time. Now, companies will prepay the rent maybe for a 12-month policy. And so if we cancel after a couple months, we get the rest of that back, what we've already paid maybe for the whole year. Like I pay for my car insurance every 6 months at a time. And then if I decide that I find a better price or something like that, then I could cancel that policy and get back what was not used. So prepaid insurance is an asset. Prepaid rent is different from rent expense. So with prepaid rent, we're paying more than 1 month's rent at a time. So let's say that a company paid all of their rent for the whole year. Let's say it's $1,000 a month and they paid $12,000. So if they're able to get out of their lease, then maybe their landlord will be able to give them back some of the money that they already prepaid, and then then they could go and get a rent somewhere else for their company. But again, if you're just paying for 1 month's rent, it would be rent expense and cash. That would be our two titles. But when we use the prepaid rent, we would use prepaid rent and cash. So it's a little bit different because we're paying for more than 1 month at a time. And we'll use those as we go through from chapter 2 all the way through the end of the class. Okay, so these are T accounts, like I mentioned, and with the T accounts, the only thing that you want to know about T accounts and debits and credits, because this chapter introduces debits and credits, is that debit means left and credit means right. So we abbreviate debit, and that goes on the left side, with DR, because in the old days that used to mean debitor, so we abbreviate it DR. And the right side is credit or creditor. In the old days that they've just abbreviated or changed a little bit to just be credit. So debit is left, credit is right. That's the only thing that debit and credit means at this point in time. Okay? Now, for our assets, we add on the left and we subtract on the right. And our normal balance for all of our assets is going to stay on that debit side, because we all like to be positive cash. So as an example, you would add cash on the debit side, subtract on the credit side, and so we all like to be positive cash, so that's our normal balance side. Now in the T account over to the right, we're going to label this liabilities. And again, put a little asterisk up there at the top, but put 2. And we're going to go down to the bottom, and we're going to put our 2 stars or asterisks there. And this is going to apply, remember liabilities are things that we owe. This is going to apply for accounts payable, notes payable, mortgage payable, which we'll get to later on in our class. And then we're also going to learn unearned revenue. So any of our liabilities, anything with payable on the end or unearned in the front is a liability, because these are things that we owe. So liabilities are things that we owe. Now going back up to your T account for liabilities, debit is left, credit is right, and we add on debit and subtract on credit. I'm sorry, I did that backwards. Sorry. We subtract on debit, add on credit, make sure you change that. And our normal balance side of our liabilities is the credit side. So again, liabilities, things that we owe. All right, going back over to the left, we're going to have a T account for capital. And this is going to be for our investments. Again, label it debit left, credit right. For our capital, we add on the credit side. Nothing goes on the debit side, and our credit side is our normal balance side. So hopefully you can kind of see the normal balance side of the account is going to be the side that we add on. All right, then to the right, the next one is revenue. And again, debit is left, credit is right. For revenue, we add on the credit side. Nothing goes on the debit side. And our normal balance is that credit side. So all revenue will go into our T account for revenue. All right, underneath capital, back to the left, this is our drawing account. And this is for all the owner withdrawals. Remember that that is a legitimate transaction for a company. The owner invests, that goes in capital, and then the owner can start taking the money back out that they invest through the drawing account. We have to keep track of it, but it is legitimate in our accounting world. Okay, debit is left, credit is right. For drawing, we're going to add on the debit side, and nothing goes on that credit side. And the normal balance is your debit side. So again, this will keep track of all the times the owner takes out money for personal use, makes those withdrawals from the company. All right, and then the last T account, which is over on the right side, is expenses. So each expense is going to get its own T account, so there'll be one for rent, one for advertising, one for wages, one for utilities, things like that. Debit is left, credit is right. For expenses, we add on the debit side, nothing goes on the credit side, and our normal balance is that debit or plus side. So with this T account helper sheet, you want to keep this out for all of chapter 2 because we'll use it again in the second half as well. And we'll refer back to T accounts even after chapter 3 because of the fact that, or in chapter 3 and into 4, and anytime that you want to get a picture of something, we can always make out a T account. Now what we're going to do is we're going to put the same transactions that we learned in chapter 1. We're going to use those same transactions for expressions with Sylvia Workman, and we're going to go ahead and put them into this new form called T account. So we're going to go away from the accounting equation that we did in chapter 1, and we're going to put them into our T accounts, but the same concept is there, that your assets still have to equal your liabilities and equity. Now, what I want all of you to do is when you're done with the demo for chapter 2, and you're starting to work on your homework, put this under your pillow when you go to sleep and it'll seep right into your head. I'm kidding. But you need to memorize this because this is the way that our accounts are set up. So again, keep out your helper sheet and use that for our demo. Okay, so with that, again, what we're going to do is we're going to take the same transactions that we learned in Chapter 1. These are the exact same ones in the demo for Chapter 1. And we're going to put them into our T accounts. So if you flip your paper over, or if you have your second side here, here's our T accounts. And we still have our accounting equation up here at the top. Assets equal liabilities plus equity plus revenue minus expenses. You'll notice under the assets, these are the assets that Sylvia Workman did have. And we have cash, we have accounts receivable, we have furniture, and we have store equipment. And your debit sides and credit sides are already listed with the plus and the minus on it. Under our liabilities, we had notes payable, that's labeled as well. Equity has capital and withdrawals, that's labeled as well. And then you have your revenue, which is our hair cutting services, so that's labeled as well. And then your expenses, we only had the two, if you remember, for wages and for rent. So those are labeled also. Now, again, as we do go through the demo for Chapter 2, what we're going to do is we're going to go through the same transactions like I mentioned, and we're going to put them into our T accounts. This will give us a better idea of how much cash we have, how much revenue we have, without having that very confusing accounting equation worksheet. So our first transaction is that Workman invested $3,000 cash and $15,000 of equipment and expressions. Now remember, when we have the owner invest money into the company, we're going to add the cash. So let's go ahead, and with our T account for cash, we're going to add to cash. That goes on the left. I'm going to put a letter A here and 3,000. Again, just like Chapter 1, no .00, no dollar signs. Then what we're going to do is we're going to put the other part that she invested into the company, $15,000 of equipment. So we're going to go down here under our store equipment. We're adding to the store equipment. So we're going to put letter A and 15,000. So we have invested the cash, 3,000, and the store equipment. Now the one thing with the T accounts is that your debits have to equal your credits. So if I have two debits here, 3,000 plus 15,000, that has to equal the credit, which is going to be our capital investment. That's going to go on the plus side. Remember, from our helper sheet, we can't put anything on the debit side of capital, so this has to be a credit. So we're going to put letter A and 18,000. So again, our debits have to equal our credits, so 3,000 plus 15,000, that's our debits, and that's going to equal 18,000 for the credit side. So that's our first transaction, letter A. For the second one, expressions paid $600 cash for furniture for the shop. So remember, anything that says paid is going to be a subtraction to cash. So we're going to subtract from cash, put that on our minus side, letter B, and 600. And what did we get for our $600 cash? We got furniture. Remember, you have to have debits and credits equal, so here's our credit, so the other half has to be a debit. We're going to add to our furniture, letter B, and 600. So we have our credit to our cash we subtracted, and then we have our addition, or we're adding to the furniture with our $600. Okay, so that's letter B. Letter C, expressions paid $500 cash to rent the space in the strip mall. So we're going to pay out some cash. This is letter C. We're going to minus our cash, 500. And then what did we get for our $500? We got 1 month's rent. So we're going to put that into our rent. That's going to go on the plus side because we're going to keep track of all of our rent. So we're going to put letter C and 500. Again, remember that you cannot put anything on the credit side of your expenses, and so that has to go to the debit. So here's your cash credit, and here's your debit to our rent expense. All right, for letter D, we purchased $1,200 of equipment on credit using a long-term note payable. Remember, this does not have anything to do with cash. There is not cash listed in that transaction. So we purchased some equipment. So we're going to add to our equipment. This is going to be letter D and $1,200. And now we're going to owe money. So that's going to go under a note payable. We're going to add to the note payable because we owe that money. So we're going to put this as a plus. So letter D and $1,200. Again, remember you have to have a debit and a credit. So our debit we added to the furniture because we bought more furniture. And then now we owe money, so that's going to be a plus to our note payable, and that's going to be $1,200. Okay, letter E. We're opening up for business. Cash received from the services provided the first week and a half of business is $825. So we receive cash. When we receive cash, we add to cash. So we're going back to our cash. We're going to add. So this is going to be letter E, $825. And then we're going to put that as revenue because we provided the service. Again, remember we can't put anything on the debit side of revenue. So we're going to put letter E, and we're going to keep a running total of our revenue in our credit column. So we add to the revenue right here, and we add to cash, but the cash is the debit and the revenue is a credit. All right, then for letter F, this is our customer who we provided haircutting services for, $100, but they did not bring their wallet that day. So they're going to pay later. So we did provide the service even though cash did not exchange hands between Sylvia and the customer. So it's still considered revenue. So let's go to our revenue account first. This is going to be letter F and 100. And again, no cash exchange hands, so our customer owes us money. So this is going to be our accounts receivable. They owe us money, so it goes on the debit side. So this is going to be letter F and 100. Again, we have our credit to revenue. That's the only side that can go on. And we're going to add to the balance of our customer's accounts receivable, $100. All right, now in letter G, that customer is going to pay us. So they're going to give us a $100 check for the services that we did on August 15th. So we're going to receive money. So let's put that up here in our cash. So we're going to add to cash 100. And then the other half is we're going to subtract from accounts receivable because the customer is paying us money. So that goes on the minus side, 100. So on the debit side is when they owe, and the credit side is when they pay. Debit side's when they owe, credit side's when they pay. So here's our debit, we added to cash, and then here's the credit for 100. All right, letter H, we paid $125 cash to the assistant for working the grand opening. So paid cash, we're going to go over here to the cash minus side, letter H, $125. And then this is for wages. Remember, again, we can't put anything on the credit side of those expenses. And so we're going to keep a running total of all the wages that we have for the month. So we put that on the debit side, letter H, $125. Again, our debit is to expenses and our credit is to cash. Subtract from the cash, then we're going to keep track of the wages on the debit side. All right, letter I is going to be like letter E. So we're going to add to our cash and add to our revenue. All right, so for letter I, we're going to add to cash $925. This is for services provided for the second half of the month. I'm sorry, $930. And then we're going to add to the revenue on the credit side, the only side we can be on, $930. Okay, now for letter J, we're going to pay $400 towards the principal of our note payable for that equipment that we bought on August 4th. So we're going to pay $400. So let's go to our subtraction side of cash. This is letter J and 400. And now that's going to go towards that note. Now, we subtracted from the cash on the debit side. We don't want to put this on the credit. We can't have two credits, so the other side has to be a subtraction to our note. So we're going to put letter J on the minus side with 400. We don't want to put it on the credit side again because our debits have to equal our credit. But if we put it there, then it would look like we owe $1,600 instead of $800. So this is when we owe is on the credit side, and the debit side is when we pay. So when you owe, it's on the credit side. When you pay, it's on the debit side. All right, and then our last transaction is letter K. The owner is going to withdraw cash for personal use. Again, we're going to pay out some cash, write the owner a check. And so we're going to subtract from our cash, letter K, and that's going to be $900. And we're going to put that into our withdrawal T account. Remember, we can't put anything on the credit side of drawing. And so we're going to put that on the debit side to keep track, letter K, and 900. So again, these are the same transactions that we learned in chapter 1. We're putting them into a little bit different form called T accounts. And again, debit means left, credit means right, and then the only difference is what is the normal balance side for that type of account. Remember, assets are on the debit side, liabilities credit, capital is credit, withdrawals are debit, revenue is credit, and expenses are debit. Again, follow your helper sheet and it will help you a ton. Okay, now the next thing we're going to do is we're going to foot and balance. And so what we do here is we want to make sure that our debits equal our credits so that we can say that everything balances out. So once you have all your transactions into the T accounts, we'll start with cash. We're going to draw a line across our cash T account. And what we're going to do here is we're going to add up the debit side, which is money we took in, and that's going to be $4,855. Then we're going to add up the minus column. This is what we paid. So that was $2,525. So debits, money that we took in, credits, money that we paid. Then we're going to take the money we took in and subtract the money that we paid out. So we're going to draw another line. And on that plus side, we're going to write BAL for balance. And we get $2,330 that we have left in cash. For our accounts receivable, we're going to draw a line across. The debit and the credit, they zero each other out. So we will write balance on the debit side and put 0. For furniture, because there's just one transaction, we'll draw a line across, put balance on the debit side, and 600. For store equipment, we're going to draw our line across, put balance on the debit side, and 16,200. So again, the normal balance side of your assets is the debit side, so you want to keep that balance on that debit side. Now liabilities is the opposite. So our normal balance goes on the credit side. So we're going to draw our line across. We owed $1,200, we paid $400, so our balance is $800. For capital, we'll draw our line across, and our balance for the owner's investment is $18,000. For the withdrawals, the owner only made one withdrawal, so on our debit side, we'll write balance and 900. So again, normal balance side, capital is credit, withdrawals is debit. All right, revenue, we'll draw our line across here. Normal balance side is credit, we'll write balance, and we get $1,855. Wages, we can pay our worker more than one time during the month, or our workers more than one time during the month. So we keep all track of that on the debit side. So we write balance and 125. And then for rent, we do the same thing, draw our line across. We're going to keep that on the debit side and write balance and 500. So we've now footed and balanced out our T accounts. Now, to make sure our debits equal our credits, in the middle of your paper here, just draw a great big huge T. And I'm going to label this DR on the left for debit, credit goes on the right, okay? And we're going to list all of our debit balances on the left side, and then we're going to put all of our credit balances on the right side. So we'll just, make a big T account and make sure our debits equal our credits. So I'm going to put cash on the debit side because that's our normal balance, and $2,330. Accounts receivable, I'm going to put 0 because that is the balance. Furniture, $600 debit balance. And then store equipment, that's a debit balance of $16,200. Okay, liabilities, we have a credit balance of $800, so I'm going to put our note payable is a $800 credit balance. Capital is next, so I'm going to list capital as a credit and $18,000. Drawing, that's a debit, so we're going to go back over and put drawing. Drawing and withdrawals is interchangeable, so you can call it either one, and that's a $900 debit. Our hair cutting revenue, services revenue, that's a credit, so I'm just going to put revenue and $1,855. And then the last two are our expenses. We have our wages expense, and that was $125 debit. And our rent expense is a $500 debit. So I listed the ending balances for each of the T accounts on either the debit or credit side, depending on how they came out, excuse me, in the T account. All right, down here at the bottom, we're going to draw a line across our T account, and I'm going to write totals. And I'm going to add up my debit side, and I'm going to add up my credit side. So my debit side is $20,655, and my credit side is $20,655. So my debits and credits equal. I'm going to double rule each side of that balancing of the T account. I'm just going to double rule that so that we know that our debits equal our credits. So again, same thing we learned in chapter 1, just a little bit different form using the T accounts. Again, debit means left, credit means right. Follow your helper sheet as to what side adds and what side subtracts. You have quite a bit, I'm going to say quite a bit, but you have some problems. Unfortunately, our book does not give you some T account practices, so I have 2 problems that I made up that are in your homework packet for chapter 2 in Canvas. But only, again, follow your schedule for what you have to do for the chapter 2 homework for this part. So this is the first part of chapter 2, and you're just going to complete the quick studies, these exercises, and then the T account problems. If your T account problems don't come out for some reason, shoot me a picture, and I will be more than happy to help you with those. So again, make sure that you follow that. Alright, so this ends the first half of our chapter 2 demo. Go ahead and work on your homework, and then you can come back and learn the chapter 2 second part.